Let me begin with one simple truth. In investing, small things, repeated every year, add up to very large things over a lifetime. The stores of compounding are mercilessly indifferent to our wishes. They reward what we actually do, not what we intend to do. If you want a portfolio that works for you, you must make decisions today that your future self will thank you for. Costs are the quiet thief of investing, and the tragedy is that most investors never notice the robbery until decades have passed. When you first begin building a portfolio, a fee of 1% or even 0.5% seems harmless. It feels like a small toll for professional management or glossy marketing. But investing is not a one-year game. It is a lifelong journey measured in compounding, and compounding has a remarkable ability to magnify everything, including the damage done by cost. What looks tiny today becomes enormous over 20, 30, or 40 years. The math is unforgiving. Every dollar lost to fees is a dollar that never gets the chance to grow, and every year that missing dollar fails to compound, the gap widens. Most investors underestimate just how damaging this can be. Imagine two identical portfolios earning the same gross return. One is burdened with a 1% annual fee, the other with a near zero cost. Spread over a lifetime, the low-cost portfolio can end up thousands, even hundreds of thousands ahead, not because it earned more, but because it kept more. The market's return is generous. Its generosity becomes yours only when you refuse to surrender it to unnecessary expenses. That gap between what the market gives and what you actually receive is defined almost entirely by cost. And because costs are certain, while returns are not, controlling them is the only guaranteed way to improve your outcome. There is a common temptation to believe that higher costs buy better performance. The financial industry spends billions reinforcing this illusion. Fancy language, complex strategies, and expert forecasts are wrapped around products that quietly siphon money away year after year. Yet the evidence year after year shows that most high-cost funds underperform their low-cost counterparts. Costs are a hurdle that must be overcome before a manager can even break even with the market. The higher the fee, the higher the hurdle, and the higher the hurdle, the lower the odds of success, especially across long periods. The most powerful advantage an investor can claim is not genius, timing, or insider knowledge. It is thrift. It is the willingness to say no to unnecessary layers of expense and complexity. By choosing the simplest tools, broad, low-cost funds that track the market, you avoid the friction that destroys returns quietly and steadily. You don't need a parade of analysts or elaborate strategies. You need the discipline to understand that the return generated by the market is already enough if you don't give too much of it away. The truth is, investing works best when it is stripped to the basics. Own a diverse slice of the market, hold it for the long run, and keep costs to an absolute minimum. Every dollar saved in fees is a dollar working for you, not against you. Over a lifetime, that difference becomes monumental. The market will do its part if you let compounding unfold. Your responsibility is simple. Protect your return from the one villain that is always present, always predictable, and always under your control. Trying to beat the market is one of the oldest obsessions in finance and one of the most consistently disappointing. The irony is that the harder most people try, the further behind they fall. Markets are unpredictable, often irrational in the short term, and brutally efficient at sorting guesses from reality. Every stock picked, every forecast made, every attempt to jump in and out at the right moment carries a cost, sometimes in fees, sometimes in taxes, and often in mistakes. And while a few exceptional individuals may win for a stretch, the odds of doing so repeatedly over decades are extraordinarily small. The market is a powerful machine, and it humbles even the most confident players. Owning the market outright is the cleanest, most rational alternative. Instead of trying to figure out which handful of stocks will shine and which will stumble, you take the entire basket. A broad, low-cost index fund holds thousands of companies, from the giants that dominate global commerce to the smaller firms quietly building the next wave of innovation. By owning all of them, you automatically own the winners at the moment they become winners without having to predict anything. You sidestep the traps that come from overconfidence, bad timing, and emotional decision-making. Instead of trying to outsmart a system fueled by millions of investors, you stand on the shoulders of the entire economic engine. The beauty of this approach is its reliability. Year after year, the overwhelming majority of active managers, professionals with research teams, powerful data, and full-time focus, fail to beat the broad market. If those armed with money, talent, and information consistently struggle, what chance does the everyday investor have? It isn't a matter of intelligence, it's a matter of math. To outperform the market, you must take from someone else. But once costs and fees are considered, the field shrinks dramatically. By contrast, a low-cost index fund doesn't need to beat anything. It simply delivers the market return minus a tiny expense. And because those expenses are so small, that almost always puts index investors ahead over time. Owning the market also builds patience into your strategy. When you stop chasing hot stocks or timing trends, you free yourself from the anxiety that ruins long-term results. Instead of reacting to every headline, you trust the natural resilience of capitalism. Over long periods, economies grow, businesses innovate, and the market rises. By capturing that entire arc, you let compounding do its work without interruption. It's a slow, quiet process, but its power is unmatched. Most importantly, owning the market aligns your portfolio with reality rather than hope. You are no longer betting on predictions. You are participating in the collective success of thousands of companies serving millions of customers. That broad participation gives you stability, growth potential, and protection from the failures of any single investment. While others are busy forecasting storms or chasing trends, you are consistently collecting the return the market provides, a return built on real earnings, real productivity, and real human progress. In the end, the smartest move is often the simplest. Don't try to beat the market. Own it. Let it work for you, not against you. The long-term rewards of that humility and discipline are far greater than any short-term thrill of getting a prediction right. Diversification is one of those ideas everyone nods along to, yet few truly practice. Many investors think they're diversified because they hold a dozen stocks or a mix of trendy funds. In reality, they are often concentrated in a single sector, a single theme, or a single kind of risk. True diversification isn't about collecting names, it's about spreading your exposure so widely and so sensibly that no single mistake, no single company, no single economic cycle can derail your long-term plan. That kind of diversification doesn't require complexity, it requires breadth. Broad market funds, both in stocks and bonds, offer that breadth in its purest form. Instead of trying to pick the companies that will thrive, you hold all of them. You own thousands of firms across industries, technology, healthcare, finance, energy, manufacturing, and everything in between. When one sector struggles, another might be thriving. When one company falters, countless others continue to grow. This natural balancing effect is one of the greatest protections an investor can have. It cushions against shocks, smooths out volatility, and keeps your long-term compounding machine running even when individual pieces of the market break down. The same logic applies on the bond side. Holding a wide range of high-quality bonds, government, corporate, and diversified maturities brings stability to your portfolio. Bonds may not dazzle with spectacular returns, but they provide something far more valuable: ballast. When stock markets shake, a diversified bond allocation often steadies the ship. It's the counterweight that helps your emotions stay in check, because even the most rational investor becomes vulnerable when their portfolio swings wildly. Stable income, predictable payments, and lower volatility make balanced diversification across bonds an essential part of long-term investing. Little investors fall into the trap of believing they can improve diversification through complexity, adding exotic assets, chasing alternative funds, or layering on strategies that look sophisticated but often add nothing but cost. True diversification doesn't come from owning more products. It comes from owning the right mix of broad, low-cost exposure. Just a handful of total market funds can give you access to the entire world's economic activity. That simplicity is powerful. It keeps you disciplined, reduces your chances of making costly mistakes, and ensures your portfolio behaves the way you expect it to. Concentrated bets may feel exciting. They give the illusion of control and the hope of big wins, but they also expose you to big losses, the kind that can set your financial life back years. Diversification isn't about avoiding risk. It's about managing it intelligently. It's about accepting that you don't know which sector or company will shine next, and building a portfolio that doesn't depend on being right. A deeply diversified strategy acknowledges uncertainty and transforms it into long-term strength. In the end, diversification done properly is an act of humility and wisdom. It limits the impact of the unknown and lets the broader market do the heavy lifting. By keeping your approach simple and spreading your investments widely across both equities and bonds, You protect yourself from the dangers of concentration and give your wealth the best chance to grow steadily over time. A successful investment journey is built on a foundation far sturdier than predictions or impulses. It rests on a clear plan, a thoughtful mix of assets designed to weather both prosperity and panic, and the discipline to stay with that plan through every season the market brings. Without that structure, emotions take over. Greed pushes you to chase rising markets, fear drives you to sell during declines, and the constant noise of the financial world pulls you in every direction except the one that leads to long-term success. Sensible plan is the anchor that keeps you from drifting. Asset allocation is the heart of that plan. It's the deliberate decision about how much of your portfolio belongs in stocks, how much in bonds, and how much, if any, in cash. That mix should reflect your temperament, your goals, and your capacity to endure volatility. Stocks offer growth but come with sharp swings. Bonds offer stability but grow more slowly. Balancing the two allows you to capture the wealth-building power of equities while buffering the storms that inevitably strike. No one allocation fits everyone. What matters is choosing one you can live with through thick and thin, because a plan abandoned during turmoil isn't a plan at all. Once you've set that mix, the real discipline begins. Markets don't sit still. When stocks surge, they can swell into a larger share of your portfolio than you intended, leaving you more exposed to risk than you realize. When markets fall, equities might shrink below your target, leaving you too conservative just when long-term opportunity is greatest. These slow drifts can fundamentally change the risk profile of your portfolio without you ever making a deliberate choice. That's where rebalancing steps in. Rebalancing is a simple yet remarkably powerful act. It means periodically selling a portion of what has risen and buying more of what has lagged, nudging your portfolio back to its original allocation. In doing so, you enforce a behavior most investors struggle with, selling high and buying low. It is a mechanical discipline, immune to emotions, headlines, or market hype. It keeps your risk level consistent, restores balance, and grounds your investment experience in rationality rather than reaction. This process doesn't need to be complicated. You can rebalance once a year, or even once every couple of years. You can set specific percentage bands that trigger a rebalance when an asset drifts too far from its target. The important thing is not the frequency, but the consistency. The act itself is what puts long-term discipline into motion. It prevents your portfolio from becoming something you never intended simply because the market had a strong year or a rough one. Sticking to a plan is not always exciting. It doesn't create headlines or bragging rights, but it protects you from the two greatest threats to long-term success: the unpredictable swings of the market and the unreliable impulses of human nature. A well-chosen asset allocation, paired with steady rebalancing, forms a strategy that is both humble and powerful. It acknowledges uncertainty while giving you control, and over decades, that quiet discipline often proves far more successful than any bold attempt to outsmart the market. The market will do what it always does: rise, fall, surprise, and confuse. Your job is to remain anchored with a plan you trust and the discipline to maintain it. You give your investments the resilience and stability they need to grow steadily over the long run. Patience is the quiet force that separates successful investors from anxious spectators. In a world obsessed with speed, immediacy, and constant action, the idea that doing nothing can be the most powerful strategy feels almost counterintuitive. Yet time is the greatest ally an investor will ever have, and compounding works only for those who allow it to unfold without interference. Every interruption, every emotional reaction, every attempt to time the market, every switch into the latest fad slows the natural power of growth. Wealth isn't built through frantic trading, it's built through calm endurance. Compounding is simple in theory, but extraordinary in practice. When your money earns returns, and those returns themselves begin earning more returns, the growth curve becomes exponential. But that magic needs long stretches of uninterrupted time. When you jump in and out of the market, you break that chain. Missing even a handful of strong days or selling during a moment of panic can set your progress back years. That's why patience isn't just a virtue, it's a financial strategy. It ensures your capital is always present when the market delivers its strongest advances, many of which come after periods of fear or uncertainty. Market timing tempts investors because it plays to the illusion of control. The idea that you can sidestep declines and only participate in gains feels empowering, But history shows this is a losing game. No one consistently predicts the exact moments when markets turn. People may guess correctly once or twice, but long-term success requires far more than luck. Even professionals fail at timing with remarkable regularity. The market moves on news no one sees coming, and reversals often begin before the average investor feels safe. Those who wait for perfect clarity usually miss the very rebounds that drive long-term returns. Fads work the same way. They create excitement, urgency, and the belief that there is always a faster path to wealth if only you jump early enough. But fads burn bright and die fast. The assets that create lasting wealth are rarely the ones capturing headlines. Real value grows slowly through business expansion, innovation, productivity, and the steady functioning of the economy. When you anchor yourself to these fundamentals rather than the noise of trends, you give compounding a stable foundation to build upon. Patience also protects you from yourself. Fear and greed are powerful emotions, and markets are designed to provoke both. Prices fall sharply and suddenly, tempting you to abandon your plan. Then they climb just as sharply, stirring regret and pushing you into high-risk decisions. But when you approach investing with patience, when you commit to letting time, not emotion, dictate your choices, you avoid those costly behavioral mistakes. You allow the long-term upward trend of markets to work in your favor instead of fighting against it. The truth is simple. The greatest returns don't come from brilliance, but from endurance, from staying invested when others panic, from ignoring the daily noise, from trusting the long arc of economic progress. Compounding rewards those who give it time, and time rewards those who remain steady. Wealth grows quietly for the patient. You just have to stay the course long enough to see what the years are capable of building. So what should you do step by step? Choose broad market index funds with the lowest reasonable fees. Set an asset allocation you can live with. Diversify across markets. Rebalance at set intervals. And ignore the siren songs of market timing and star managers. Do these things consistently, and the market will, over time, hand you returns that active frenzies and fees would otherwise steal. If you want perfect, realize there is no miracle formula, only disciplined practice. Build a simple, low-cost portfolio, treat it like a business you own for the long run, and resist the urge to tinker. Your future self will thank you.